I'm recording this late Monday, February 9th, 2026, and I need you to listen to every word I'm about to say. What happened today was historic. Silver exploded higher, up nearly 6% to close around 80 to 83s. For those who held through last week's brutal crash, today felt like vindication. It felt like victory. Your account is green again, the fear is gone, and right now, the single biggest emotion you're probably feeling is the temptation to sell. You're thinking, I survived the crash, I've made back my losses and then some. I should take my profits off the table before this reverses. It is a normal, rational thought. It is the safe thought, and it is the single biggest mistake you could possibly make right now. I am issuing this emergency update with a clear, unambiguous message. Don't sell. Whatever you do not sell your silver on Tuesday. Because as big as Monday was, Tuesday will be bigger. What we saw today was the tremor. The earthquake is tomorrow. What we saw today was the ignition sequence. The rocket launches tomorrow. I've been studying silver markets for over 2 decades. I have seen dozens of rallies and dozens of corrections. I have never, and I want you to understand this completely, I have never seen a setup like the one we have going into Tuesday's trading session. Every indicator, every market mechanic, every piece of fundamental data is pointing in one direction, explosive upside. I'm going to spend this entire video explaining with data and logic exactly why Tuesday is positioned to be one of the most explosive days in silver market history. You will understand the forces that drove Monday's rally and why those forces will be amplified exponentially on Tuesday. By the end, you will understand why selling now would be like getting off a rocket ship 1 second after liftoff. Subscribe to John AG Alert immediately and hit that notification bell. I will be posting live updates tomorrow as this unfolds. Like this video and comment now because engagement determines who sees this critical information. Share it with every silver investor you know who might be tempted to sell. You could be saving them from the biggest financial regret of their lives. Let's start by deconstructing what happened on Monday because it sets the stage for Tuesday. The rally today, taking us from the high 70s to nearly $83 orders, was not random. It was not a dead cat bounce. It was not short-term noise. It was driven by 4 specific identifiable forces that I want to walk you through in detail. First, you had the initial short covering. The banks and commercial traders who reshorted the market during last week's rebound, betting on another crash, were immediately proven wrong at Sunday night's open. When prices gapped higher and kept climbing, their pain became acute. They began covering their most vulnerable positions, creating a steady stream of buying pressure throughout the session. Let me explain why this short covering was just the beginning. When a trader covers a short position, they are forced to buy. This buying pushes the price higher. The higher price then puts more pressure on other short sellers, forcing them to cover. This creates a feedback loop, a virtuous cycle for longs and a death spiral for shorts. On Monday, we saw the first rotation of the cycle. The weakest shorts folded, but the big players, the banks with billions at stake, are still in the game. They are bleeding, but they have not yet capitulated. That capitulation is coming on Tuesday. Second, you had the physical market pressure. The massive divergence between paper and physical prices with Shanghai at $130 and COMEX at $80 created an undeniable upward pull on the paper price. Arbitrage may be broken for the big players, but the price discrepancy still screams that the Western paper price is wrong. That reality puts a relentless bid under the market. Think of it like a spring being compressed. The physical market is reality. The paper market is the spring. You can push the spring down temporarily, but eventually it must snap back to reality. The further you push it down, the more violent the snapback. We have pushed this spring down to historic levels. The snapback is now in progress, and it will not stop until the paper price meets the physical price. That convergence point is not 83 out of dollars. It is somewhere north of $130. Third, you had retail FOMO. Investors who watched the 31% crash and the 22% rebound from the sidelines finally got the courage to jump in. They saw the green candle on Monday, and the fear of missing out overwhelmed their fear of another crash. This wave of retail buying added fuel to the fire. I track retail sentiment through social media, through dealer sales reports, through search engine trends. On Monday, the term buy silver hit its highest search volume since the 2021 Wall Street bet squeeze. Dealers reported a surge in orders that crashed several websites. This retail wave is powerful, but it is also just beginning. The retail investors who moved on Monday were the early adopters, the ones who follow markets closely. The mainstream retail wave, the people who hear about silver from their coworkers or see it on the evening news, has not arrived yet. They will arrive on Tuesday and Wednesday. Fourth, you had the very beginning of gamma hedging. As silver pushed above $80, market makers who were short call options at the 80ers and $85 strikes began to buy small amounts of futures to hedge their positions. This was the initial spark. It was not the explosion, but it was the fuse being lit. Let me make sure you understand this gamma dynamic because it is the most mechanical, predictable, and powerful force in Tuesday's setup. I will explain it in more detail shortly, but for now, understand this. What happened on Monday was the market makers testing their risk models. They saw the price approaching their strike prices. They bought a little bit of protection. On Tuesday, if the price continues higher, that little bit of protection becomes panic buying. The algorithms do not negotiate. They do not hope, they execute. These four forces combined to give us a powerful 6% update. It was exciting. It was validating, and it has lulled many into a false sense of security thinking this is a good time to take profits. They are wrong, because every single one of those four forces will be amplified by an order of magnitude on Tuesday. This is the core of my thesis. Monday was the preview, Tuesday is the feature film. Let me show you why. Reason by reason with the level of detail you need to understand the magnitude of what is coming. The short covering we saw on Monday was the easy part. It was the traders with weak stomachs and tight stop losses getting out. On Tuesday, we enter a different phase. I call it the existential pain phase. The major commercial banks still hold massive concentrated short positions. According to the latest commitment of traders data, the four largest commercial shorts are holding a net short position equivalent to over 500 million ounces of silver. Their average entry price on many of these shorts is likely in the 40s or 50s. They have been profitable for years, but as the price climbs, their cumulative position begins to approach break-even and then loss. Do the math with me. If a bank is short 100 million ounces with an average entry of $50 and the price goes to $90, they are sitting on a $4 billion paper loss. That is not a bad trading day. That is a crisis. That is emergency meetings with the board. That is phone calls to the Federal Reserve. That is the kind of loss that can threaten the solvency of an institution. When silver crosses $85 and heads for $90, these banks are no longer just losing money on their most recent shorts. Their entire multi-year, multi-billion-dollar position begins to hemorrhage cash. This is an existential threat to their trading desks and potentially their institutions. They have two choices. They can add to their shorts, hoping to cap the price, but they tried that last week and failed. The physical market is too strong. Adding shorts now would be like trying to stop a tsunami with a garden hose. Every short they add gets immediately underwater. They are throwing good money after bad, or they can cover their positions. Not just the recent shorts, but the core legacy positions they have held for years. Positions that in some cases are foundational to their entire precious metals trading operation. When they are forced to cover these massive legacy positions, the buying pressure is not a steady stream. It is a tidal wave. They will not be buying a few thousand contracts. They will be buying tens of thousands of contracts representing hundreds of millions of ounces. There are not enough sellers at current prices to absorb that kind of buying. The price will gap higher, triggering more stops, forcing more covering in a cascade that feeds on itself. Monday's short covering was a trickle. Tuesday's short covering will be a flood. The shorts will be buying not because they want to, but because they have to. They will be buying to survive, and their survival buying will be the fuel that launches silver into the triple digits. I warned you last week about the massive wall of call options expiring this week. On Monday, we crept toward the fuse. On Tuesday, we light it. Let me explain this again because it is critical, and I want every viewer to understand it completely. Market makers have sold a historic number of call options at the $85, $90, and $95 strike prices. When a market maker sells a call option, they are taking on risk. If the price goes above the strike, they lose money. To manage this risk, they must hedge. They hedge by buying the underlying asset, in this case, silver futures. The rate at which they must buy is determined by a Greek letter called gamma. Gamma measures how quickly their hedge needs to change as the price moves. When the price is far from the strike and there is plenty of time until expiration, gamma is low. They do not need to hedge much, but as the price approaches the strike and expiration gets closer, gamma increases dramatically. It becomes nonlinear. It becomes explosive. Here's the key insight. Gamma is exponential near the strike price and near expiration. We are now both near the strike prices 85.90 and near expiration this Friday. This is the maximum gamma environment. Every dollar the price moves higher forces exponentially more buying from market makers. On Monday, with silver at $82, the gamma on the $85 calls was present but manageable. Market makers were buying futures but at a measured pace. If silver moves to $84 on Tuesday, that gamma doubles. If it hits 84 over 50, it doubles again. At $85, it reaches maximum intensity for that strike. And then crucially, the gamma from the $90 strike, which was dormant, begins to wake up. This creates a mechanical nonlinear acceleration. It is not driven by human emotion. It is not driven by fundamental analysis. It is driven by risk management algorithms that have no choice but to execute. The market makers' computers will be forced to send a tsunami of buy orders into the market, regardless of what anyone thinks about silver's fair value. If silver breaks $85 on Tuesday, the gamma from that strike will push us toward $90. As we approach $90, the even larger gamma at that strike will detonate. This gamma bomb will be an explosion of forced buying that is mathematically certain to occur if we cross the trigger levels. This is the mechanism that can take us from $85 to $100 in a single trading session. It is not fundamentals. It is not narratives. It is pure market mechanics. And the setup for it to happen on Tuesday is as perfect as I have ever seen. On Monday, we saw retail FOMO. The individual investors who watch YouTube and follow Twitter piled in. That is a powerful force, but it is nothing compared to what is coming on Tuesday. Institutional FOMO, pension funds, sovereign wealth funds, family offices, and large asset managers do not make decisions overnight. They have committees, they have risk models, they have investment policy statements. They move slowly. They were watching last week's chaos from the sidelines, assessing the situation, running their models, debating in their conference rooms. Monday's powerful rally was their confirmation signal. It proved that the crash was a shakeout, not a trend change. It proved that buyers were in control. It proved that the downside was limited and the upside was potentially enormous. The institutions that have been considering adding silver exposure just got the green light from their risk committees on Tuesday morning. Their buy orders will hit the market. These are not small orders. These are orders for millions or tens of millions of dollars. An institutional decision to allocate just 0.1% of their portfolio to silver can be larger than the entire daily volume from retail traders. A single sovereign wealth fund deciding to add a 1% silver position could represent buying pressure equivalent to weeks of retail flow. This institutional wave of capital has not arrived yet. It will arrive on Tuesday. They will be chasing performance. They will be trying to get exposure to the hottest asset class on the planet. They will be explaining to their boards why they missed the move and desperately trying to get on board before the next leg higher, and their buying will arrive at the exact moment the short squeeze is accelerating and the gamma bomb is detonating. Imagine 3 separate tidal waves, short covering gamma hedging and institutional FOMO all converging on the silver market at the same time on the same day. That is the setup for Tuesday. That is why I'm telling you not to sell. The underlying reality driving all of this is the physical market. The Shanghai price of 130 versus the Conx price of 83 is the fundamental truth that cannot be ignored. The paper market can pretend for a while, but eventually it must reconcile with reality. On Tuesday, that reconciliation accelerates. On Monday, the paper price began its journey toward the physical price, but the gap is still massive, nearly $50. This gap creates an arbitrage that, even if it cannot be fully exploited by institutions due to delivery failures, creates a relentless upward pull. Every market participant can see the gap. Every analyst is writing about it. Every trader is asking, why is there a 60% premium in Shanghai? The answer that COMEX cannot deliver physical metal is becoming mainstream knowledge. On Tuesday, the market will fully internalize the realization that taking delivery from COMEX is not a viable option. This realization will cause a panic into physical silver. Dealers will be overwhelmed. Premiums will explode even higher than they already have. The stories of sold-out dealers and month-long wait times will hit the mainstream financial news. This panic into physical will spill over into the paper market. Investors who cannot get physical will buy SLV or futures as the next best thing. They will reason that if they cannot own the metal, at least they can own a claim on the price movement. This creates even more buying pressure on paper, accelerating the squeeze. The irony is that this buying of paper, driven by the inability to get physical, will push the paper price toward the physical price, closing the gap from below. Tuesday is the day the market collectively realizes that the emperor has no clothes. COMEX has no silver. The paper price is a lie, and the only way to get exposure is to bid the paper price up to where the physical market already is. That level is not 83. It is well over 100. The market is just beginning to figure this out. Mainstream financial media is always a day late. They are reactive, not predictive. They report what happened yesterday, not what will happen tomorrow. On Monday, they were still processing the crash and the initial rebound. Their headlines were cautious. Silver rebounds after volatile week. They were hedging their bets. On Tuesday morning, every financial news outlet, CNBC, Bloomberg, The Wall Street Journal, Fox Business, will be leading with the story of silver's explosive rally. They will have charts showing the V-shaped recovery. They will have guests explaining the supply deficit. They will run segments on the Shanghai premium. They will interview dealers who have run out of inventory. The narrative will shift from "is silver done" to "how high can silver go?" This media coverage will bring in a new wave of completely uninformed retail money that just saw the headlines. These are not the silver stackers who have been accumulating for years. These are not the sophisticated investors who understand the short squeeze dynamics. These are regular people who see silver surges on their TV screen, decide to buy because they do not want to miss out. Their buying is emotional, undisciplined, and arrives at the peak of the euphoria. This dumb money wave is the final powerful fuel for a parabolic move. It is the last wave of buyers that pushes prices to levels that make no fundamental sense but happen anyway because of pure momentum. This media-driven wave will hit the market on Tuesday afternoon, just as the short squeeze, gamma squeeze, and institutional FOMO are all reaching peak intensity. The confluence of these buying pressures is what creates a historic generational move. So now that you understand why Tuesday will be bigger than Monday, what do you do? Specifically, why must you not sell? Selling on Tuesday would be like selling your GameStop shares at $40 in January 2081, right before it ran to $480. It would be like selling Bitcoin at $10,000 in 2020. If you sell at $85 or $90, you will lock in a nice gain. You will feel smart for a few hours. You will pat yourself on the back. Then you will watch in horror as the price goes to $100, $110, $115 without you. You will not be able to get back in. Spreads will widen to levels you have never seen. Liquidity on the ask side will disappear. Dealers will stop answering their phones. You will be stuck on the platform watching the rocket ship leave the planet without you. The regret from selling too early in a parabolic move is one of the most painful experiences in investing. I have talked to hundreds of investors who sold silver at $30 in 2011 and watched it run to $50. They never got over it. Some of them quit investing entirely because the pain was too great. Do not do it to yourself. Do not be a cautionary tale that I tell in future videos. Here is the tactical plan for Tuesday broken down by your situation. If you own physical silver, do nothing. Sit back and watch. This is your victory lap. You won. You held through the manipulation and the volatility. You own the real asset. Tomorrow is your reward. Do not sell a single ounce. The real price discovery is just beginning. Your silver is already worth $130 in Shanghai. The Western price is just catching up to that reality. If you own unleveraged paper, silver, ETFs, extra, hold, do not sell. The temptation will be strong, but you must resist it. Watch the $85 to dollar level. If we break through it with conviction, the path to $100 is open. Consider setting a target to sell a small fraction, maybe 10-15% of your position at a much higher level, like $115 or $120 just to lock in some historic profits. But hold your core position. Do not leave the table before the main course is served. If you are in cash wanting to get in, this is a high-risk, high-reward decision. The optimal entry at $65 is gone. The train has left the station, but the bigger move is still ahead. Buying at the open on Tuesday is chasing, and you need to understand that. But it might also be the last chance to get on board before the real explosion. A small starter position to get some exposure might be a rational choice with the understanding that you're buying into strength, not weakness. Size it so you can withstand a 10-15% pullback without panic. A final critical warning on leverage. Do not use leverage on Tuesday. I cannot emphasize this enough. Even in a massive up move, there will be violent pullbacks. A flash crash of fast or $10 can happen in minutes as algorithms trigger and liquidity disappears. If you're leveraged, you can get liquidated on a quick dip. Even if the price ends the day $20 higher, the volatility is too extreme for leverage. Period. Use unleveraged positions only. Your goal is to capture the move, not to maximize it with borrowed money that can wipe you out. Let's put this all together. Monday's rally was driven by initial short covering and retail FOMO. It was the warm-up act. It was the opening band before the headliner takes the stage. Tuesday's rally will be driven by existential short covering from major banks facing billions in losses, exponential gamma hedging from market makers as we cross 85 bouts and $90. A tsunami of institutional capital entering the market after Monday's confirmation, a panic into paper as the physical market becomes unobtainable, a media-fueled wave of uninformed retail buying chasing headlines. These five forces are all set to converge tomorrow. This is why Tuesday will be bigger than Monday. This is why you must not sell. I have laid out the case. I have shown you the mechanics. I have warned you about the trap of selling too early. The decision, as always, is yours. But I have rarely been this convicted about the setup for a single trading day. The banks have lost control. The physical market has spoken. The paper market must now reconcile with reality. That reconciliation happens tomorrow. It will be violent. It will be historic. And it will be profitable for those who are on the right side. This is John A.G. Alert. Don't sell. Hold on tight. Tuesday is the day we have all been waiting for. The manipulation is ending. The shorts are dying. The physical market is taking control. The gap between East and West is closing, and it is closing to the upside. Everything I have been telling you for years is now playing out in real time. Do not flinch. Do not waver. Do not let the fear of a pullback rob you of a generational opportunity. Subscribe now. Turn on notifications. I will be with you tomorrow covering every moment of this historic day. I will be posting updates in real time as the price moves. I will be calling out the key levels. I will be there when $85 breaks. I will be there when $90 falls. I will be there when $100 becomes reality. This is your moment. This is our moment. The silver market is being repriced before our eyes.